All right. Good morning, everybody. A little bit of a relief rally this morning, like a dead cat bounce kind of play. Um, didn't have the AM edition of Spot Gamma, but the PM had some pretty interesting talk in it and a discussion about this potential bounce to the upside. So worth a read if you normally skip the PM edition. Might want to take a look at it. We didn't see the sort of headlines out of Japan that would move markets. So really nothing really big there. There was a bit of a threat that there could have been something out of Japan, but it didn't materialize, so all good. Small caps leading the way this morning in the US markets, up almost 1%, with the Dow at around 0.25%, S&P and NASDAQ around a half. We're going to see some job numbers this morning. This isn't the big one, non-farm payrolls, but any job data at all you want to pay particular attention to. It goes to the Fed's dual mandate between inflation and employment. The tariff talk continues to bring up inflation talk, and inflation is like the boogeyman when it comes to getting rid of it. Just the fear of inflation can make inflation persist. So the more that anybody in any position of authority continues to say that inflation is sticky, it's not going away, and then add any discussion of tariffs making inflation worse, well, that'll just breed more fears of inflation, which continues to make it sticky and not go away. We're going to get more jobs data tomorrow, and then the big one on Friday. We've still got Fed speakers, um, including Powell on Friday, which is a little odd because, typically we would be in a blackout period before FOMC, but we can see all these Fed speakers through the week, right? We got more tomorrow and Friday. We had some yesterday. Typical Wednesday, we're going to get some crude data, 10:30. It's normal. We'll get gas tomorrow, as we normally would. 30 years ago, energy would be one of the main drivers for what would cause an intraday move, right? So, sure, it's not 30 years ago anymore, but pay attention to the energy report 10:30. Just watch the clock because there are times where the report can move markets. We've seen it before. We will see it again. Every Wednesday at 10:30, you should be looking at that report, or at least be prepared for it to come out, right? It doesn't cost you anything to be cautious. Just watch the clock. There was a little bit of talk in the overnight about dialing back on the tariffs a little bit, even within the first 24 hours of those tariffs being put on. And the market started to move because of this. But if that doesn't come through, we could see a little bit of a temper tantrum this afternoon, right? If some sort of announcement comes out that there won't be any changes to the current tariffs, or if they add more to it. So be thinking about that in the later part of the day today if we do continue this relief rally, or this dead cat bounce. This was a significant move in the overnight. I had to turn it onto a line just to so that it would show up a little better. If we put it back on candles how I normally have it, it's just this little red dot down here, right? It's just a little algo print. But that is a significant move. Certainly got my attention. If we look at the 10-year, you know, again, a little bit of a pop back up, not much, but a little back above 4.2. But the dollar sitting around 105 is still taking that beat down. And back below 100 would be typically would be a good thing, right? 10-year lower, the dollar lower, energy lower. This should all be really good for markets, and it's not right now. That's why I continue to stress, you know, be cautious, be willing to take profits on trades that are working, maybe leave a runner, but you shouldn't be trying to squeeze every penny out of your trade right now. Get the meat of the move and move on to the next one. Overnight volume at 148, they're in it and participating. They're not sitting out and hedging like we would expect to see if they were worried or hedging up in fear. We're not seeing that. Put wall around 5,700. So it is below us now. Zero gamma volatility trigger call wall still far overhead, right? We'd have to get through all of yesterday and most of Monday to even begin to challenge the zero gamma and volatility trigger. We talked about this really strong 5,800 level yesterday, and we went below it, got back up above it. We're sitting on the cog line 5811. Should this break, one of the things you want to do is just measure the entire range. And doesn't change much, you know, if I use this wick here or if I come over and use this base over here. It's not going to radically alter the outcome. But 5,700 is the number I gave yesterday. You know, just kind of round down a little bit from the 1,236 and the 111. Close enough. So 5,700 is really the line we want to stay above. We can overshoot that red zone, digest, chop about inside it. But 5,700, I think, is really the critical level that we got to keep. We got close to the lower ADR last night, 5792 cog line. When we get to one side early enough in the day, we can go to the other side by the end of the day. That wouldn't make us bullish since both of those lines are inside of yesterday's price action. In fact, we can hit the full lower ADR and still not have broke out of yesterday's range. All right, our distance from the weekly floor pivot is not even 4%. That move to the downside yesterday maxed out at minus 3.7. So we could go another 0.75% before we would start to consider that we're oversold and do some sort of relief bounce. We've got a narrow channel today. It's not as narrow as it could be, but it's still a pretty narrow channel. Narrow channels imply that if we break out, it could grow legs and we could really run. We're also in a negative gamma environment, which implies if we break to the downside, dealers will sell into it. And if we break to the upside, they will buy into it, which is not what they normally do. Normally, we're in a positive gamma, and when we break to the upside, they sell into that strength. And when we break down, they buy into that weakness. So they'll be doing the opposite. That's why in good markets, when we're bullish and consistently traveling higher and higher, the candles are usually really uniform and not all that wide, not all that big, right? That's what a good, clean market price action looks like when things are bullish. That was not a good example, but when things are not good, clean, uniform, and healthy, then the candles start to get wider, wickier. The distance we travel on a day-to-day basis become larger. And that's based on how the dealers are behaving, right? So when they're buying into the move higher, we can make big sweeping moves higher. Statistically speaking, some of the biggest up days in history happened in bear market conditions, right? Where you get one of those days where we make just this massive exaggerated move to the upside because we were in bearish market conditions with dealer gamma in the negative, and they bought into the rally and forced the rally to continue even higher. Yesterday's MDP is being applied today. Today's pivot opened lower than yesterday. That's bearish, but price opened above it, and that's bullish. Those two kind of cancel each other out. We've already hit today's pivot, so it doesn't owe us any move to get the pivot taken care of. We've already done it. S1 is still inside of yesterday's range, so if we do make another test to the downside, 57.50, big round number, options level, and yesterday's low, and an S1, right? We keep saying and down there. We'll stack as many of them as we can. It's yesterday's low, and it's 57.50, and it's an S1. Get the idea. So we didn't end up building a third distribution zone. We just widened out the second zone and brought the value area down with us. So 58.92 cog line on the upside, 57.50 on the downside, with the point of control close to 58.32. This is just a wide distribution. It's a big mess, right? No real narrow zone or trigger to really focus on. There's nothing showing that can help us to the downside, and anything to the upside is so far away that it doesn't really come into focus. 59.50 and 5,900, just big, simple, round numbers. 58.50, which ties in with last week's low. 10-day, 30-minute volume profile in TPO. The profile is in green, TPO is in blue. And, you know, I talk about these from time to time with a little depth, but I can't do it every day because it would just be this monotonous thing, right, that I continue to go over again and again. So I don't hit it every day, but the profile in blue, TPO, is time, price, opportunity. And while we can nerd out and get really specific on what it is, I always try to give people the simplistic explanation of a tool or a concept, because a lot of people just want the base case, right? They don't want to get all deep into the woods on what something is. So think of the blue one as a profile that's tracking trades, and the green one of a profile that's tracking volume within those trades. Now, TPO is not a trade profile, but it's the best way to think of it. And if you keep it that simple and you consider it from that point of view, then it becomes really helpful and useful, and you don't have to nerd out on it and spend a couple weeks studying TPO profiles. So just think of it as a trade profile. We want those to line up most of the time, right? The point of control, the value area high and low, even the distribution zones that we find, we expect them to line up to match. And when they don't, that discrepancy is what helps us out. It's why we want both of those on the chart at the same time. So that if we do find, for an example, a really high area of volume, but there wasn't a lot of trades at that level, then we kind of get the idea that, it was just a few trades that were really big and had a lot of contracts in them. $59.64 is the point of control. We brought that down from the 61.50 area. There's likely nothing that's going to move this anytime soon. And right now, it's a significant level over our head that we're going to have to get through if we're ever going to make our way back up, which we will eventually. The question is, will we base down here and bring the point of control lower so that it's already at our location, we can jump over it and continue to run back up? Or are we going to run up and challenge it? At this point, I believe if we run up and challenge it, we won't make it through. That we need to hold the line along the lows, build a base, bring that point of control down to us, and then use it as a springboard, push off of it to be back up. There's always some bobbing head out there talking about how everything's going to crash and burn. We're going into a recession, blah, blah, blah. This has been a very clean and organized sell-off. Sure, it's gotten a little violent in some spots along the way, but for the most part, it's just been very systematic, very organized. And if you keep track of the Spot Gamma Founders Note and their discussions of the VIX and positioning, whether it's through dealers or through just the broader market participants, nothing is standing out as, big, crazy bets to the downside. It's all just been very clean and organized and systematic. We have a really tight distribution this morning. A very narrow IB or initial balance. They didn't get a lot of work done last night. And the expectation is that if they have work to do today and they didn't do it last night, then the clock is ticking. They're running out of time. Half the day is already done. We got a nice little liquidity gap here at 650. Base case, we're going to run back up and at least close that gap. Then we'll figure out what they're going to do after that. But we're sitting really nice inside of yesterday's range around the midpoint. And while trading inside of yesterday's range doesn't really excite me at this point, it does give us a really nice setup. So all we got to do is break out of yesterday's range. And if we don't do that, well, yesterday was a really wide range. There's plenty of room for traders if you want to trade within it. I'll probably just go look for something else. Gold, oil, Bitcoin. There's always something to trade. But setting some alerts on yesterday's high, yesterday's low, even our own Globex high and low, looking for an opportunity to play a breakout. It's a reasonably decent gift to just be able to set your alerts and go do something else. Wait for that to break out. We're still outside of this week's range. So our weekly expected move, we're looking at 58, 56. Get back above that to be back inside the week's range. We're supposed to close inside that box at the end of the week. So the base case argument is that we would at least make it back up into that zone. 2% below the 10-day. We're still holding these lows, but it hasn't gotten worse, right? It's kind of where we were at yesterday. It's the same discussion. We're holding the line, and when we look back, that seems to be the average turning point. Of course, we've gone lower than that, but the average says that that's usually about as bad as it gets. And then we digest there, we start to correct, and we work our way back in the other direction. It doesn't imply that we're oversold or that it owes us some sort of mean reversion back in the other direction. We're 3% below the 10-week, and park the mouse there and take a look back. We've been deeper than that, especially on the far left side of my chart. That's the 2022 bear market. So sure, it got a lot worse back there. But once we've been out of that bear market, we hit 3% before back here. And then we exceeded that after hitting it here. We broke through it and immediately we came back. All right. So when we look at these times where it did get really deep, we came back across that 10 quickly. That's the expectation at this point, even if you're not bullish in the broader sense, right? Say you're not looking at like April and May with the S&P, into 6,500 in the short term, say the next 2 weeks, getting some lotto calls or building a distribution of butterflies across the upper ranges makes sense to me. Try 2% above the 10. Because if you look at these relief rallies after we did go that deep, they were crossing back through the 10-week at 2%. So go out to the weekly chart, put a 10-period moving average on there, and measure 2% higher than that. Start building butterflies or buying calls along that level. They should be really cheap, which is good because if they don't work, it will be a total loss. It won't be one of those trades that you could defend, right? When it's that far out of the money, it's a binary trade of winning and losing with no defense. So make sure they're cheap, right? You don't want to go out and spend a lot of money on a lotto. Nat gas is down, call it 1 1/4, but it's still up 9 1/4 over the last 5 days. So it was up 10.5% in a 5-day period. That's huge. It's not a surprise that it's pulled back a little bit now after a 10% move in 5 days. China getting a lot of attention with Bitcoin. If we look at the names here across the top, we got China, Bitcoin, Bitcoin, semiconductors, China, 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 uranium, chips, metals and mining, airlines, which airlines were down 7.5% in a 5-day period. They're getting a little bounce to the upside now, 0.75% this morning. So you got to kind of take it into context when you see things that are green this morning. You know, it's a part of that relief rally on some of these names. Take Bitcoin, though, over a 5-day period, you know, it's up 4% now. It's still down 1% over a 5-day period, so it was up 5% in 5 days. That's not much for Bitcoin. Doesn't feel like much of a relief rally on that one. If we're going to have a rally day and we're trying to spot that before the open, we don't have all of the tools, right? We don't really have the options data, but we do have a lot of the tools that we need to spot a rally. We've got the sectors in the Mag 7 and what they're doing this morning. Rallies can happen when we have the Mag 7 or the right sectors like communications, chips, software as a service, consumer discretionary, financials. We have those this morning. This isn't the first time in the last week that I've pointed out in the morning that we have all the ingredients for a rally and then we get no rally, right? We get into the open and they get beat down and the fade continues. It doesn't change the approach. If we're going to have a rally, this would be the ingredients that we would want to see, at least in the pre-market. Once we get into the open, we want things like, you know, CTICs, ticks, weighted AD, options flow, but those don't exist in the pre-market. So, you know, we have to wait. But this is a good start. These are the sectors that we would need for a rally day. Still doesn't mean we're going to get a rally day, but that's a good start. So crude is still bleeding. Then we got that breakdown in junk bonds. TLT down, pot stocks, transportation, which, you know, that one needs to come up a little bit more. It's not quite at our benchmark. I'm surprised it's down, really. I saw some headlines about a push for more shipping vessels and shipping containers. So I don't know. Maybe the proposed cost on that was seen as a negative, gave it a little dump to the downside. Bitcoin is a risk asset. It's a really great indicator. Even if you don't want to trade Bitcoin, you can still use it as a tool. It is a representation of risk, right? When it comes to these big funds and firms and money markets, these guys can play really safe when they want to. They may not get much return out of it, but they can really play the game and play it safe. When they start venturing out into riskier and riskier things, it shows their appetite to take risk is increasing. That is where a bullish backdrop in the market comes from. If nobody's willing to take risk and they're all just in fixed income stuff, then, you know, we're not going to get much of a rally. And hiding out in defensive names and defensive sectors isn't going to get the job done. But when they start getting into things like Bitcoin, then we can see that capital rotation start to form. But this has to stick, right? And one day, after being down 5% over the last 5 days, one day of green isn't going to cut it. We can see that we're significantly below the year-to-date VWAP. If we're going to have a sustained rally, that's one of the targets. Get back to the year-to-date VWAP, get above it, begin working our way back up. But it's a downward sloping measure at this point, and it's quite a ways off with gaps in the middle. So close the gap, get to the line, finally get above the line. Lots of work, right? Bitcoin has a lot of work ahead of it, and big, wicky, spiky moves isn't going to get it done. The meeting in China is still ongoing. I believe it's going to be going all week, and they still have an opportunity to continue to promote whatever new stimulus measures they're going to promote. Their projections seem to be the same as last year's projections on what they're going to get done. So like 5%, it looked like. But they've been saying 5% for, this is the third year. We'll see. Probably not. But they still have a chance to comment on the tariffs. Maybe throw in some more stimulus. And that would affect the China ADRs, Baba, Baidu, JD, PDD, all those guys. Uranium has this really big cup, inverse cup. We don't know if it's going to be a double bottom yet. I guess it just depends on how you consider double bottoms versus a cup. For me, a double bottom needs to go lower than the previous low because it's a bear trap. And I don't see how a bear is trapped if we match that low. What bears are piling in there if we match the low and bounce? So if we're looking for a double bottom bear trap, we need to exceed the previous low. This didn't do that. It matched the low and bounced up. And that feels more like an inverse cup, to where we're looking for maybe a little bit of a handle here and then a continued move to the downside. I don't know if that's what we're going to get. Inverse cups can bounce where we start to get the handle and then it just continues to run right back up. That's absolutely possible. But at this point, I wouldn't call that a double bottom. It is a key level. It held, we bounced. So at this point, we need to measure how high this is bouncing and look for the reversal before the continued move back down. If it gets through more than half, then obviously it's not a handle on a cup, because a handle should go about 1/3, not 1/2. And then the gold and gold miners, be careful with those precious metals. If we see some more talk on repairing this issue with Ukraine, peace should take those precious metals lower. Continued war vibes may hold the line or even continue their rally up. And looking for any sort of capital rotation, the defensive names, at least two of them, are still either flat or in the green, with utilities down quite a bit. That may be a bit of a discretionary, but it's an outlier because utilities have been tied to AI, which is tied to tech, which puts it back up in the upper category, risk on. We're seeing uranium up a little bit this morning, ties back to utilities. So, just reorganizing what we would consider defensive sectors. the risk on sectors are still really negative, and the risk off sectors are flat to positive. So we don't have the rotation yet that we're looking for. We should be done with the economic calendar by lunchtime. The beige book normally isn't that big of a deal. I know it shows it as a medium impact, but most of the time that's ends up being nothing. The Fed speaker in the afternoon is likely going to be more impactful than that. So be careful with your afternoon plays. If you're running 0 days in the morning and then 0 days in the afternoon, it's not a smooth sailing this afternoon with Fed speakers and the beige book and potentially afternoon tariff talk. So be mindful of that. So what I got for you guys, be careful, be safe. I'll see y'all tomorrow.